Hey guys, welcome back. This is, I think, episode 19, and we are really going further. I'm happy to see it. And for the engagement in the Telegram community, I'm really happy to see it. Okay, so most of these guys have not gotten the privileged, the privilege really to learn trading like this. So I just since I'm trading full time. I don't see fit to, do the free mentorship. I kind of love it. So today we'll be talking about types of inefficiency. So most times you hear me in the community call different types of inefficiencies, and so people will be like confused. You've not taught this, boss. You've not done that. We don't know about this. We don't know. So I just decided to put everything in just one video today, and I don't want this video to be too long. So make sure to stick to the end, right? Inefficiencies can also be called imbalance. Obviously, you must have already known that one. Inefficiencies can also be called imbalance. Inefficiencies are also liquidity to price and can sometimes act as draw on liquidity. Why I'm pointing this out is that most of you, right, most of the traders only take equal highs or equal lows or highs and lows as liquidity, but that's not true. Yes, they are liquidity, but they are avoiding something else. Imbalances, inefficiencies are also liquidities. They are drawn liquidities because liquidities are something that price attracted to, and mostly price reverse when it takes them out. So price reverses when it takes out a high sometimes, and price reverses when it takes out when it refills an inefficiency sometimes, right? So these are also draw on liquidity, right? Price are attracted to any inefficient zone as its main purpose is to deliver price efficiently. So what the algorithm is supposed to be doing is to deliver price efficiently, but sometimes it leaves this inefficiency on the price for it to trade back to it, then continue what it was doing. So I keep saying that if you understand these three things that price does, you understand your way around the chart, right? One, price runs for highs and lows, that's liquidities. Two, price leaves imbalance. Price leaves imbalance, yes. And three, price refills those imbalance, those inefficiencies. So if you understand those three things, you understand exactly what to do in the chart. Now, this is the first example of an inefficiency, which I think it's very common. This is a traditional FVG, fair value gap. If and you want to call it, some people call it imbalance, some people call it inefficiency, some people call it fair value gap. But imbalance, inefficiency, fair value gap, I think everything just mean the same thing. But this is traditional fair value gap. This is just fair value gap. It consists of three candles, right? Sometimes even more. But we have the first bullish candle, the second bullish candle, and the third bullish candle. But this first bullish candle week, you can see the week of this first bullish candle. It's not closing up with this last bullish candle bottom week. You can see, so it's leaving a gap there. It's leaving a gap there, and this is called what? Fair value gap. Sometimes people call these things void. This is not void. This is not void. I hear people call fair value gap void, and later on say the name doesn't matter, and also yes, the names doesn't really matter, but when you're talking about void, you're meaning another thing. It's just like you calling a high a low and calling a low a high. So you get the thing. You get the thing. Names doesn't really matter. All that matters is for it to be profitable. Yes, but even if all that matters is for it to be profitable, I cannot come one day and see a very good high and call it a low. It will not make sense to the people I'm trying to deliver information to, right? So this is a fair value gap, not a void. You understand this? This is this consists of three candles. Yes, the middle one is always where the gap is, and that's where price later comes to refill. So popularly known as fair value gap, although can still be called imbalance. You get the idea. This particular inefficiency can be used as draw on liquidities and trade entries. So you can use this fair value gap as draw liquidity. You expect price to come back to it, if not certainly, if not immediately, sometime in the future. I think I say something in the community that you can as well, you can uh, um, tell a level on the chart where you want price to reach out to. Is very very common. Almost anybody can do it if you understand price action, right? If you understand how to analyze, you can tell a level where you want to see price straight into. But one thing nobody can do is to tell when price will actually go to that level. That is just it. I might see a very perfect level, let's say a buy side liquidity, and yes, I'm expecting price to trade to take out that buy side liquidity, right? But I cannot exactly tell if price is going to take out that buy side liquidity this night or in the morning or tomorrow or next tomorrow. Price might just do its thing. It might take 2 days, it might take 3 days, it might take even a shorter period of time to get to the buy side liquidity. So all you just need to know is where price will react to, and that's the thing. Most people predict. You want to tell when price reacts to this, oh, on Monday, on this, on that. That's not how it really works, right? Sometimes you get flopped along the way. You don't predict. You just wait for price to show it, do its thing, and you react, right? So another FVG is inverse FVG. This FVG is not really common because most people don't really know about this FVG. Trust, most people don't know about this FVG. ICT himself made me understood how this FVG works. In case you don't know what I'm talking about or what I mean by ICT, inner circle trader, you can search him on Twitter or um, YouTube, right? So this kind of averages, you can see it consists of candles that were bullish before and price completely filling that average without reacting to it. Are you seeing the logic here? You see that there's a fair value gap there, right? The price is not reacting to that fair value gap. Price just broke through that fair value gap. And there's a very, very high chance that when price is coming back again, price will likely react to that fair value gap. We'll be getting the point. This inverse average is not really common, but if you study, you go to your chart, you certainly see it. You certainly see it. You have a fair value gap you're expecting price to react to, but at the end of the day, price doesn't react to it. It broke through it with just maybe momentum or not momentum, but it broke through it. That is what an inverse fair value gap. You can draw it out, and it can sometimes act as support and resistance to price. Very, very important. Why do I say it can sometimes act as support and resistance to price? Because if price have broke through this fair value gap, once price is trading back to this place, it can just retest. This is what most of I think the retail concept, not retail traders, retail concept. We are all retail traders, okay? So the retail concept, this is kind of what is all about, like the breakout idea, right? Breakout and retest. So this inverse FVG can also act as support and resistance. If it breaks it, it turns to what? It turns to resistance, and price just retests to it and continue trading back. So don't take my word for it. You can go back and find these things out for yourself. Go and study these things, right? So volume imbalance. This is another type of inefficiency, and most people have seen me outline this on my chart several times. Most people have seen me outline this on my chart several times, yeah, and they've not really gotten the idea of why I do it or why I outline it, or is even a thing. Most people ask, is it even a thing? Volume balance and inefficiency. Yes, most people think, this is kind of because the weeks are all, and this is not really common. But to the ICT traders, it's very, very common. It's very, very, very common to the ICT traders. Volume imbalance. You have price, a bullish price. It can be bearish, not only bullish. I'm just doing examples for the bullish candles. So we have a bullish candle here. Then price, price opened, closed here, but it reached out to this point. This is the high of that candle. Then price jump from closing here, jump to opening. Price jumped to opening here, right? Then reach out for this low before trading back higher. You can see what I'm trying to point out there. If you don't get my point, exactly, you can take the video back, right? So this is a volume, but this is now volume imbalance because we are left just wicks, no candle there, no candle is filling those gaps, just only what? Wicks. This is not a fair value gap, this is a volume imbalance. Price most times straight back to it. You can go and study these things, go and find it on your chart, write it on your note and find it on your chart. Volume imbalance are also strong drawn liquidity, very strong, especially on the higher time frame. Higher time frames like weekly time frame, daily time frame. If you see volume imbalance anywhere, there is a high probability that price will trade back to that volume imbalance just to refill it. Go and study your charts. Go and read, study past data. I'm not telling you to just pick everything I'm telling you here and boom, you start putting it in live trading. No, go and study these things first to confirm. Don't take my word for it, right? So they can also be used for entries, just like the fair value gap can also be used for entries. The fair value gap for the OT or the simple entry module or however I want to call it, they can be used for entries. Volume balance can be used for entries. Very snipe entries. Okay, now the last one we have is void. This void can come in different ways, but when you see when you see price action like this, note that this is just called void. How do you mark void? From the closing of this other candle to the opening of this other candle, that void, all of that, that will drop price. All these inefficiencies act as magnets. Price is supposed to deliver. The algorithm is supposed to deliver price efficiently, right? So all this inefficiency act as magnets for price to make it efficient before doing whatever it wants to do. So the algorithm notices these things and comes for it. You get my point? Go and study the chart. This is what void looks like. In case you see it anytime, I do mark it. All of these inefficiencies differs, right? But price is always attracted to any of them available on the chart. They differ, like what they do and the names or how they form, but all of them have just one purpose. Price is always attracted to them, and they sometimes act as a draw liquidity. So the void most times can be the new week opening gap. That's NWG. Most of you must have seen me annotate this on my chart. If you are in the Telegram community, if you are not there, you can join with the description on the channel. You can join with the link on the description of this video, right? So void can be the new week opening gap or the new day opening gap NDOG. But what differs this? You cannot just you cannot just pick any void. I see people doing these things. I don't really like it. You cannot just pick any void and call it annotate it as the NDOG or the NWOG. Void can happen anywhere on the chart, yes, but the one that we call the new week opening gap or the new day opening gap is like it correlates with time. I'm going to teach about that. It correlates with time and has kind of special purpose, right? So, but it's all void, all void. So the void is a strong inefficiency that price mostly consolidates inside of it. So sometimes void can act as a drawn liquidity where price will reverse on, but sometimes price just consolidates inside it, and sometimes it can act as what support and resistance to price. Sometimes it's just there, then price sweep it out and it acts as an inverse FVG. I don't know if I'm going to, when I'm talking about the NWG, when I teach about NWG and NDOG, I'm going to use my chart and point out these things where the NWG can act as support and resistance, or the NDOG can act as support and resistance. And sometimes price consolidates inside the NDOG for a very long time before giving a very strong up movement or down movement, right? So that's that for inefficiency. It's a very short video, and I hope you like it and hope you find it insightful. And I, even if you can't tell me right now, but I want you to promise me one thing, please. Just don't take my word for it. Go to your chart, write these things down in your notes. Go to your chart and find them for yourselves, so you can add it to your strategy and know how to use it. You get. So if you find this video insightful, like I said earlier, subscribe, like, and share the video because there's more lecture coming on. Right. So until next time, be safe.